All right. Yeah, guys, in case you don't recognize my face, I'm Angelo. I am the investment and compliance associate here and do a lot of the day-to-day trading and investment research here at the firm. So, like Sean said, just going to cover a couple slides here just on some historical data, and hopefully it just gives you guys some perspective. And obviously, like I said, if there's any questions in the chat feature, I'll be monitoring that. And if I have an answer for you on the fly, I'll definitely do my best to get that. So first slide here, just historical performance in a recession. So just to kind of explain what's going on this slide, the blue logarithmic graph here is just the market, the stock market, and the growth of $100 from 1926 all the way up until, I believe the data goes until 2021. And all of these green bars that you see are recessions. So going back to 1926, we've had 16. That's about 6 a year. And the jury's kind of out on if we're currently in the middle of one or in the middle of one or not. You kind of don't know that it was a recession until looking back in the past. But just one thing to point out is that a lot of the times before these green bars, you have the market starting to dip a little bit. And vice versa, as you're in the middle of the green bar and you're in the middle of a recession, the market a lot of the time will already start going up because it's trying to, the market's always just trying to predict the future. So the market right now, it's up around 10 to 15% from the lows of when it dropped in the 20 to 30% range to start the first half of the year. So it's kind of a sign of that the market's hopeful that this is the worst, and things going forward in the next year or two will start to get better. This next slide, cost of trying to time the market. And what this shows is the growth of $1,000 going from 1997 to, again, 2021. And what happens if you miss the best week or the best month or the best 3 months? So what this is saying is, if you missed the 6 months from basically, what would that be, March 4th to September 4th in 2009, the growth of $1,000 would have only amounted to $6,728, versus if you stayed fully invested over the whole time period, it would have grown to $10,367. And I think really the point to drive home here is a lot of times when the markets are volatile, the initial reaction is to sell. And the tough thing with that is that you have to sell and also time and get back in at the right time. And a lot of the times, the behavioral biases, which Angelo will touch on when she starts speaking, is the market will keep going down further. And while you're waiting for that perfect time and thinking that it's going to keep going down further, it's already up 20%, and you're buying back in at a higher point than when you sold. So just having a plan in place and not panic selling, panic buying, just sticking to that plan is pretty important. And excuse me, the last slide that I want to cover is just when you look at returns in your investments, there's two sources of that. There's the actual price appreciation, and then there's the income piece to it. And this on the left here is the total return for the ag, which is just like the stock market has the S&P 500 as a typical index. This is the ag, which is for bonds. And as you can see, a large majority, if not pretty much the entire return from bonds, comes from that income piece. So when times are bad and on paper you see that you're down X percent or X amount of dollars, the income stream from your stocks, from your bonds, they're still being paid. So it's at those times that when that income's coming in and you're reinvesting it, putting it in investments that might, on paper, it's scary, they're down, that's where you get a lot of that return. And how in that graph 2 slides ago, when you start to really see the graph go up really, really quick, it's because all that capital, it's just getting invested at lower and lower prices. And also when, looking, this slide on the right here is the year to date, like the top gainers. And or it's sorted by yield. So a lot of the higher yielding stocks, or the higher dividend paying stocks across the board in all the sectors, those are the stocks that are up actually. So even though the market itself is probably down in the 10 to 15% range now, if you're owning those high quality dividend paying stocks that are constantly returning cash, you're up or slightly down versus that huge, some of the lower yielding stocks that might not be as profitable and they're trying to grow, there's a lot of red. They're down more than what the market is. So, just the key point here is, again, just don't focus on the paper losses or what the number on the screen says, and stick to the plan that you have in place, because when it's there, you're still getting an income stream from the bonds, coupons, and the stocks, dividends. And we're reinvesting that, and it's a long-term gain.